We also have a sweeping tax bill that's in the US Congress as well, going into the Senate. So there's some pretty large risks going into June this year. Now, I think we're actually in a very historical period where you're going to see more and more capital shifting away from the US and more towards safe haven markets, which I think Singapore will also enjoy some of those inflows. Now, that's something that we want to focus on today's show. We will focus on the REIT sector and try to answer the question whether this is a safe haven or not, following a lot of conversations our analyst Krishna has been having with investors as well as some of the REITs themselves. We'll also talk to economist Brian on the latest Singapore manufacturing data and what all that means to the trade outlook as well as GDP. And I will run through Singapore's banks system lending numbers for April and how that kind of fits into our sector call. And last but not least, we will go across the border and have a look at IHH Healthcare, why analyst Natasha is keeping a big buy on this stock. So with that, let's start with Krishna. Now, Krishna, welcome to the show. Now, Krishna, you've been very busy with the REITs results season and also talking to a lot of clients. You've been at two very specific public speaking events in Singapore as well as Bangkok last month, plus hosted events with a number of REIT managements from CLAS, AA REIT, OUE REIT, Parkway REIT, as well as Sasur, and a few more as well. So let's start with the 30,000-foot view. Can you break down what were some of the key themes across the different REIT subsectors when it came to the first quarter results?
Thank you, Thilan. Thank you for having me in the show again. So I think the three key themes that came across from the results of the last quarter, two of them kind of cut across all the subsectors. And so those two are on the capital management and investment management. What we are noting, and this is on the brighter side of things, so what we're noting on the capital management is we saw a quarter-on-quarter decline for most of the REITs for the all-in financing cost. And the REITs also have maintained their full-year cost of debt guide, which suggests that on a year-on-year basis, the debt cost will come down. The second bit is the investment management, and this should not be surprising to anyone. I think given that macro environment that we are in, most REIT managers are noticing that their capital recycling efforts, the investment and divestment activity, have taken a bit of wait and watch mode as the buyers and sellers are revisiting their underwriting assumptions. And the final bit is on the operation side of thing. Again, not too exciting, but for us, it is not a negative surprise given the uncertain macro environment we are in. We are noticing that even for some of the domestic theme, there is weakness. We are seeing the overall retail sales a bit sluggish for both F&B and the general retail. And for the REITs, we are seeing some occupancy slippages across subsectors. But we continue to see the Singapore-focused names continue to outperform the overseas one as of now.
Got it. Now, as I said, you have hosted quite a few REITs live one-on-one with the management. So what are some of the key takeaways from some of the specific REITs that you hosted?
Yes, I think the discussions were that investors had with the company managements. I think they were mostly on sort of broad themes and some of the specific queries for individual counters. So I think once we went through the meetings, most of the queries were focused on tariffs, what the management views the impact is, and how they're trying to mitigate the impact. To some extent, on the industrial sector, there were queries on the Johor Singapore SEZ and what will be the impact on that. And then for the retail sector, I think the broader theme is, the retail sale is sluggish. There is an upcoming RTS in next 2 years. So how the whole sector will pan out. Data center was also quite discussed in the meetings. I think from its resilience that we are seeing in terms of this broad sector thematic, as well as the upcoming capacity that is coming up in the region. Individual REITs that we hosted, I think what probably is a bit more concerning is on the hospitality side of things. And again, we are coming from a very high base of the last year, and some of the key drivers in terms of the corporate demand and China demand is a bit more on a slower side. So that kind of were the main sort of discussion points between investors and the company managements for the meetings that we hosted.
Got it, Krishna. Now, on the other side of the coin, you also spoke to quite a lot of investors as well over the past month. What are they saying and how are they positioned?
Yeah, I mean, I don't have any visibility on the flows on our desk, but based on the discussions that we had with investors whom we met recently, it appears to me that their positioning is a bit more on the lighter side, and it's a bit more selective positioning. So I think their concerns are pretty much the same what we have discussed just now. I think the concern on the tariffs and how that will impact the sector. But there is a broad agreement that the Singapore is best positioned to tackle this situation and any kind of impact that may have on the overall economy. And there is also broad consensus that the Singapore dollar base interest rates is declining, so that will have a positive spillover on the financing side of things. So in my assessment, it appears that investor positioning is light and very selective. So I think if anything, then there is room for a rotation into the sector if the interest rate declines continue to happen and GDP and the uncertainty that we are in currently kind of subsides.
Got it. So investors are pretty lightly positioned. So how should we think about the sector going into the second half? Is this the time to kind of raise some weightings? And if so, what are some of your top picks?
Yeah, so we are maintaining our positive view on the sector. I think this continued safe haven flows that we are seeing, the strong currency that's there for Singapore, and also the falling Singapore interest rates, the government policy and stability, these all augur well for the sector. And I already mentioned about what I think is a bit of light positioning from investors in this sector. So there is room for rotation. Now, given I'm well aware of the macro uncertainty that is there, so we are recommending a bit more of selective positioning, a combination of the ones which are focused on the domestic theme, as well as some of the selective, more liquid high yielders. So our topics in the name are in the sector are CapitaLand International Commercial Trust, CapitaLand Ascendas REIT, Fraser Centrepoint Trust. These will broadly be within the sub-theme of the domestic large cap names. And then within the high yielding space, we have Mapletree Logistics, Mapletree Industrial Trust. And within the bit more of a defensive name, but it is more of a small cap illiquid ones as a Parkway REIT on the healthcare side of things. And finally, on hospitality side, which is not our preferred subsector, we recommend CapitaLand Ascot because of its diversified presence. So these 6-7 names are our top pick in the sector.
Got it. Okay, thanks, Krishna, for that. Now let's before we move on to Singapore macro, let's just have a quick look at Singapore's latest bank lending data. Now, Singapore's bank loan growth was showing some signs of cooling. April's total loans grew at about 3.4% year on year, down from around 4.2% growth that we saw in March. And this was the slowest pace of growth year to date. Now, despite the fact that we're expecting some Fed rate cuts, we think loan growth will remain muted in the low single digits for 2025. Now, this reflects heightened macro uncertainties, especially around the tariff risks that we are talking about, and also slowing business momentum. Non-residential loans saw a surprising pullback. Now, this was a segment that has been growing a lot faster. It was down 1.4% on a month-on-month basis after a very strong March. Business loans were the key driver. They fell about 1.6% month-on-month, led by general commerce, which is mostly the SME sector. The only bright spot was transport, which was the only non-negative category, rising about 0.3%. And I think this is partly due to front loading that we are seeing across some of the businesses because of all the tariffs. Residential loans also slipped by 0.5% month on month, reversing some of the gains we saw in March. Again, the biggest contraction here were the SMEs. So there is a bit of fear from the SMEs, I think, in terms of deploying capital because of all this uncertainty. And I also think the banks are taking a little bit more of a cautious view on extending capital to this sector as well, given all the uncertainty. Now, on a positive note, consumer loans actually remain strong. It was up about 4.7% year on year. This was a 5-year high. Housing loans were up 3.6%, largely from domestic demand. We also saw a big jump in credit cards. I think people are traveling a little bit more around the region given the stronger Sing dollar, and that's actually reflecting on the credit card side. On the liquidity side, deposits continue to rise, rising about 6.1% to a total system deposit close to $2 trillion now. We saw both fixed deposits and saving deposits rising. So we think there is that safe haven flows coming into Singapore. So overall, we don't really see much to change our neutral view on the Singapore bank sector. We think credit demand will be muted and margins also are a bit tough going into the second half. So we think the managements have kind of kept their guidance back in with the first quarter results. We probably will see some revisions downwards when the second quarter results are announced in August. So something to watch out for there. So we don't really have a lot of drivers here to raise any of our bank sector calls to buys at this stage. Now, with that, let me move to our macroeconomics and have economist Brian on the line. Brian, welcome to the show. Now, Singapore's manufacturing hit a 3-month high on a month-on-month seasonally adjusted basis in April. Can you catch us up on what are the drivers behind this increased pace?
Yeah. Hi, Dylan. Thanks for having me on the show. Yeah, so manufacturing was strong in April, and I think this was driven primarily by two components. The first is transport engineering, and I think that's because air travel remains strong, so there remains high demand for commercial airline maintenance, repair, and overhaul jobs. And the second component is electronics. So what we are seeing is that Infocom and consumer electronics, as well as the key sector of semiconductors, output remains very robust in these fields. And that could be as a result of robust AI demand, as adoption widens, and also because right now there's the 90-day truce, and manufacturers are trying to front load production. Yeah.
Okay, so that's some of that front loading is starting to show through. Are there any sectors that we should be concerned about that's already starting to show some tariff impacts, do you think? And what should we be paying more attention to going forward?
So for now, well, the data is a bit noisy, right? Because as I said, we are in the 90-day truce, and at the same time also, I think the US and China agreed to suspend tariffs for 90 days from early May, right? So I think what happens, Singapore's role in the global supply chain basically is upstream electronics components. So I think with other countries also having their tariffs at a baseline of 10% as compared to very, very high Liberation Day levels, they've also been ramping up and trying to front load production, and as a result, I think there is spillover demand for Singapore's electronic components. Right. That said, I think the production data was a mixed bag. We did see contractions in chemicals and also the general manufacturing cluster, as well as biomedical manufacturing. So right now, I think we are wary that the trade uncertainty could be starting to weigh on certain segments as well. Yeah.
Got it. And how's this feeding into your GDP forecast? And also, if you can give us your views on how you think MAS will continue in terms of their Sing dollar policy.
So we think that outlook-wise, manufacturing and exports will likely hold up in the second quarter. due to the front-loading dynamic. However, in the second half, as trade slows amid uncertainty and also amid high uncertainty over the outcome over the tariff negotiations, there will likely be some payback. So we will see Singapore's export and external facing sectors like manufacturing and also wholesale trade, transport and storage. We should see a slowdown in the second half on that front. Nonetheless, I think if you look at the first quarter data, it came in at a very strong pace of 4%. In the second quarter, we are likely to see above 3% pace as well due to the temporary tailwinds that we are seeing right now. So overall, even with a slowdown in the second half, our forecast for the full year still stands at 2.4% GDP growth, which is well above MTI's what we think conservative forecast of 0 to 2%. Accordingly, MAS has already eased twice, right? In January and April, it has eased its slope to a modest appreciation pace, and we are of the view that MAS can stand pat for the rest of the year and just hold monetary policy at this what is already somewhat of an accommodative pace. Yeah.
Great. Thanks, Brian, for that. Brian, that's our economist, Brian, on the line there. Now, let's move across the causeway to Malaysia. It's a public holiday in Malaysia today, but Natasha Ariza released the report late last week, which I thought was quite interesting, on IHH Healthcare. This is one of Asia's largest private hospital groups. It is a diversified multinational healthcare provider with operations in Malaysia, Singapore, India, Turkey, and beyond. It owns marquee hospitals like Gleneagle and Mount Elizabeth and Fortis, and has a total market cap of around 61 billion ringgit. Now, let's first start with the first quarter results. They were pretty solid. Revenues are up about 5.7% year on year. EBITDA margin stayed strong at around 2.1%, and net profit clocked in at about 521 million ringgit, which was in line with expectations. Now, Malaysia led the charge with about 17% revenue growth, thanks in part to the recent acquisition of Island Hospital. India and Turkey also showed pretty steady demand, while Singapore was slightly weaker due to the renovations that is ongoing at Mount Elizabeth. So what's the forward story? Bed capacity is set to expand by around 4,000 beds by 2028, with major growth coming from Malaysia as well as India. Fortis is also expanding. Sri Man Hospital is joining the fold, and renovations in Singapore for Mount Elizabeth is set to wrap up by year end as well. So that all of this should help them stage a 2026 rebound. We expect 2025 to 27 revenue growth of around 9 to 11% annually, with EBITDA hitting about 7.3 billion ringgit by 2027. The stock is pretty defensive in nature. It's got a growing regional footprint, and margins are set to improve, especially in this sort of very uncertain market. So, and a buy rating has about 17% upside. Now, there are downsides, risks to be sure. One is rising staff costs. There's also regulatory headwinds in Malaysia and Indonesia, and there is forex exposure that has to be taken into account. A stronger ringgit could clip valuation slightly, but the long-term fundamentals remain intact. So we maintain a buy call on this stock. With that, we don't have our chart guy today. He's off because of the holiday, so we'll have him back next week. In terms of upcoming events, we got Singapore's PMI readings coming out on the 3rd of June. Retail sales are out on the 5th. Unemployment rate, quite important, out on the 9th, and Nodex coming out on the 18th of June. With that, we are out of time. Thank you so much for joining us. Have a profitable trading week, and we'll see you next week.